Good morning and welcome to The Street on BNN Bloomberg. I'm Roger Peterson. Thanks very much for joining us. Coming up on the show today, Andrew Pyle, Senior Investment Advisor and Portfolio Manager at CIBC Wood Gundy, is our guest co-host. And of course, we want to hear from you this morning on First Call. Reach out with your questions and we'll have Andrew answer as many of them as he can. The number to call will be 1-855-326-6266. We'll open the phone lines in about 30 minutes. And our email address is firstcall@bellmedia.ca. Here are some of the stories we're tracking now for you in the BNN Bloomberg newsroom. CTV News is reporting Prime Minister Mark Carney will announce measures today to help Canadian steel producers and those in softwood lumber. Multiple reports suggest more financial aid will be announced for both industries. The move comes as steel, aluminum, and the lumber sectors continue to deal with high tariff rates imposed by U.S. President Donald Trump. Brookfield Asset Management and Singapore's wealth fund GIC have offered to buy Sydney-listed National Storage Real Estate Investment Trust in a deal valued at more than $2.5 billion US. The Australian self-storage provider says it aims to strike a deal by December the 7th. National Storage operates more than 270 storage centers across Australia and New Zealand. The Globe and Mail is reporting the Canadian Securities Exchange is considering buying CBOE Canada and CBOE Australia. The report says talks are preliminary and there's no guarantee a deal will emerge. A CBOE spokesperson told the Globe the company was selling its Canadian business after only a few years because it is realigning its portfolio of businesses to sharpen its strategic focus. And now our top line story, the possibility that a memorandum signed by Ottawa and Alberta could give way to a new pipeline. However, BC, though, is likely intending to fight it. CTV's Mike LeCouture has more.
We fought successfully, I might add, so many pipeline battles in British Columbia.
A stern warning from the president of the Union of BC Indian Chiefs. His group is firmly behind coastal First Nations in opposing a pipeline in that region.
At the end of the day, if things go sideways, then we're out on the ground. We're, at the designated sites.
Grand Chief Stuart Phillip wouldn't say if that could include rail and road blockades like those that sprung up in 2020 in support of the Wet'suwet'en hereditary chiefs who were protesting another energy project.
The Honourable Leader of the Opposition.
Conservative leader Pierre Poilievre wants to know when the signing of a memorandum of understanding with Alberta will lead to shovels in the ground.
On what date will construction begin on a pipeline from Alberta to the Pacific?
Prime Minister Mark Carney said that's not the point of the agreement.
The memorandum of understanding that we're negotiating with Alberta creates necessary conditions, but not sufficient conditions, because we believe in cooperative federalism. We believe the government of British Columbia has to agree. We believe that First Nations right holders in this country have to agree and support.
But does that mean First Nations will have a veto over the pipeline? Not according to the former Minister of Natural Resources and current BC Liberal MP.
Well, I think the Supreme Court was pretty clear on Trans Mountain that there's no effective veto on the part of any particular First Nation.
Same goes for the provinces, even as Prime Minister Carney promises collaboration with BC. Minister of Natural Resources Tim Hodgson says that the ultimate jurisdiction for interprovincial pipelines rests with the federal government.
All right, that was CTV's Mike LeCouture. Let's bring in Andrew Pyle, a Senior Investment Advisor and Portfolio Manager at CIBC Wood Gundy, to talk a little bit more about this pipeline. Do we have reason for optimism? Do we just have to look at a reality that probably this may not progress?
If this was 5 months ago, I think we'd be talking a little bit differently right now, Roger. I think, there is a good chance I think this can go through. It's going to have tremendous opposition, as we've just seen. But meanwhile, the rest of the world just keeps moving. I mean, this is a market that we need to tap into. I think they've made that pretty clear. And without the capacity to get product to the coast and to export markets, we're going to lag further behind. So it's going to be really interesting how this pans out. But again, it's a different mood today than it was 5 months ago.
And there's lots of things to get through on this. You've got the First Nations who we heard them in that report not happy about it. But then we also heard that they may not have an Indigenous veto. So that in itself.
Well, I mean, the point's pretty clear in terms of what the Supreme Court has said. Based on that, you would think this would go through. But, the government has to hedge its bets right now. We just got through a pretty precarious budget in terms of getting the vote through. So we don't have a ton of support right now at the federal level. So I think, it's going to be a long process to get this through. And even then, Roger, as you know, this isn't going to happen overnight. I mean, it's going to take a while to get this into construction. So.
Does it feel like there's an appetite from business for this, or are everybody just taking a wait and see approach?
Well, the appetite was huge not too long ago, and the appetite's fading a bit. And I think, over time, the rest of Canada starts to forget about why we were talking about becoming a little bit more self-sufficient in other export markets in the States. That can get revitalized very quickly, depending on what Trump does in the next few weeks or few months. But I think that appetite has waned a bit, and that makes it a little bit tougher for this to push through.
And with the U.S., does it feel like they're looking at it at all? Do you think that saying, well, if this does go through, maybe we should be concerned, but they don't expect it to?
It's hard to say how the States looks at this, right?
It's hard to say how Trump looks at a lot of things.
We're talking about coal again in the States. I mean, who would have thought that possible a year ago? And I don't really think the States is looking at this. I frankly don't think they care what markets Canada ultimately serves, as long as they can get served by Canada in terms of the fossil fuels that they require. So I don't really think the States is as interested in this as we should be.
So it looks, and the other interesting thing I was looking at this is we're already hearing from Liberal MPs in BC who are apparently showing some concern because, politically, it could be almost political suicide for them.
Well, this is the main point, right? We're talking about a province that opposes it. We're talking about Indigenous groups that oppose it. And you're an MP in that province. It makes it really tough to push for this to go forward. And that's why, again, I think we're going to be talking about this for weeks, Roger, if not longer. Before this ultimately gets resolved one way or the other. And what the political fallout of that is going to be, positive or negative for the Liberals in Ottawa. And
this is still only, we haven't even heard the MOU yet.
Well, and this is a crazy thing. We're getting into the weeds on something that we don't even know what direction this ultimately takes. And so I think, we're going to be talking about this for a while.
What do you think it signals for a bigger picture, the infrastructure projects, the nation-building projects that Carney has talked about? What do you think, what kind of an impact will have on those?
Well, hopefully we have the ability to kind of separate those projects out. Pipeline to the West Coast has always been a very tenuous proposition. The other projects, however, I think are as important, and they're separate. And I think we can probably continue to proceed with that. We continue to talk about Churchill. How do we get LNG to Europe? There's other ways to get LNG to Europe, and I think those projects ultimately go through. Roger, this is going to be one of those isolated issues, as it always has been.
Okay. On that note, Andrew, we're just going to head to a little break, but we'll be back in just a few minutes. We're going to be talking about investment overseas, also the UK budget. It actually accidentally got leaked by the budget office there. More coming up after the Let's see how things are shaping up on the markets right now. We'll start with the U.S. futures. And you can see there in the positive, it looks like the rally is going to continue heading into the Thanksgiving long weekend south of the border. Everybody's in the green right now. Optimism down there over a federal rate cut helping drive that. Looking overseas now, taking a look in Asia. A good day all around there. Again, same thing, optimism over that possible Fed rate cut in the U.S. and the rebound in the U.S. markets driving the Asian markets higher. You can see, look at the Nikkei up 1.85, Hang Seng up by 0.13, and the CSI 300 up by 0.6%. Heading to Europe, and it is budget day in England. The FTSE's up 0.1%, CAC 0.45, the German DAX 0.36%. And the TSX closing at a record high yesterday, 30,900, and intraday slightly higher than that, also a record high, of course, and it was up by nearly 1%. And taking a look at some of the movers from yesterday. The RP up nearly 8%, Denison Mines 6 1/3. And going the other way, Parex Resources off by 4.5%, Kelt Exploration down by 5.8%. And taking a look at the gold prices, silver prices, copper prices, all of them up right now as people look for a safe haven, and there's industrial demand. Gold's up by 0.4, silver up almost 2%, and copper up by 1.7. And oil continues to struggle. It was off the Western Canadian Select down by nearly 2%, 45.34. And south of the border, a similar situation. And it was off again. The WTI down. It's below 58 at 57.84. And we're back now with Andrew Pyle, Senior Investment Advisor and Portfolio Manager at CIBC Wood Gundy. And the markets, after it was a rough November for the U.S. markets, shaping up to be one. Now it's kind of bounced back, but there's opportunities elsewhere, and you want to look a little bit more. You're thinking overseas, there's some places to find some good deals. Yeah, that's been a theme for us all year, Roger, taking a look outside of the States, which for a lot of investors have been hard. We've talked about growth stocks. We've talked about the Mag 7. It's difficult for some to look at that and say, well, then I'm going to look elsewhere, Europe or Asia. But the reality is, for a lot of these markets, we've actually seen outperformance over the States. And I think that's a pattern that we will see continue into 2026. So we've been gradually kind of piecing away from U.S. exposure, piecing into Europe, whether it's the UK, whether it's Germany, Japan, other parts of Asia. And we do think that that's where the opportunities lie. And what do you look for when you're going over there? Well, we're looking for a couple of things. First of all, we're looking for value. Because again, if you look at the market in the States right now, and I think most people would agree, even after the pullback that we've seen, the market's generally overvalued relative to other segments. We can go to Europe and we can find equities that still offer good value. They're not trading at ridiculous multiples, and they're in growth industries. Now, for Europe, for this year, it's been mainly defense, but we start to see that broaden out. And the same thing applies to Asia. And I would argue, Roger, even in the emerging markets right now, we can find decent value where we really can't find that value in the States. With defense in Europe, with talk of a possible peace deal between Russia and Ukraine, we'll see what happens, of course, with that. Any concerns of what kind of impact that might have on the defense industry there? I don't think so. I think the genie's out of the bottle on defense right now in Europe. I think Europe is not going to just stop in terms of the transition to a greater military spend. I think that continues into 2026. Again, we're talking about investments that take a while, Roger. We haven't developed a capable European military machine to the extent that perhaps Trump would like to see overnight. That's going to take a while. So therefore, I think that spend continues. And that's one segment of the market. But I think the one thing investors need to look at is if we're going to promote growth in that one segment, it actually does filter out into broader areas of the economy in Europe, which actually supports growth, supports revenue, and ultimately comes back to support the valuations in those markets. I just want to ask emerging markets, and we're going to quickly chat about the UK budget, but what emerging markets are you liking? We actually think China right now is a place that we think offers value. We think parts of Latin America offer value. If we look at Brazil, for example, I think there's decent investments there. Other parts of Asia, I mean, Japan has been a great market to invest in this year. Some would argue right now perhaps those valuations are lofty. But we think, and again, if you believe that rates in the States are going to come down, which most economists believe will happen, that will typically be positive for emerging market debt and typically be positive for emerging market equity. All right, let's chat a little bit about the UK budget that was released accidentally by the Office for Budget Responsibility. There was great irony in the fact the Office for Budget Responsibility actually released its assessment of the budget less than an hour before it was actually officially announced by Treasury Chief Rachel Reeves in the House. Now, it has apologized, but how are the markets? You were taking a look at some of the response so far? I think the markets are really taken in stride. I mean, this was a very anticipated budget. We've been talking about this for weeks, Roger. It's almost like a make it or break it. We've seen UK debt markets come under a significant amount of pressure just simply because investors really did not believe they could put a fiscal package together that was going to address debt, address deficits going forward. The budget that we've seen this morning, I think, does address some of that. Investors seem to be okay with what they've seen, enough so that they can actually ignore the fact that we leaked this thing, less than an hour before the actual report. So I think for now, the markets are giving Rachel Reeves a
a bit of a pass.
Yep.
We'll see if that continues in the days ahead. But looking at the bond market right now for gilts, I mean, we've seen a decent move lower in yields. She's going to be relieved on that.
All right, and some of the numbers. The UK economy raised its growth forecast to 1.5% from 1%, but lowered it for 2026 to 1.4 from 1.9. And some stealth taxes they may be coming in, targeting higher earners, including a freeze on income tax thresholds. I'm just reading this as we go, and a cap on some tax-free pension allowances. Will any of those things disturb anybody, or are they willing to absorb them?
Well, the biggest concern is going to be, does this eat into economic growth more than we've already seen, right? The forecasts, I think, that are in the budget, Roger, are reasonable in terms of looking at growth going forward. They did lower productivity growth estimates for the UK. That's not a great thing, but I think the magnitude of that downward revision is not huge. To the extent that these tax increases actually impede growth, we'll have to see. But I think if we're looking at some of these higher, I mean, for example, $2 million plus or £2 million plus homes, I don't think that that's necessarily going to eat into growth enough to push these deficit forecasts offside.
Okay, we'll leave it on that right there, Andrew. Thank you as always. And we're going to be back with Andrew. He's the Senior Investment Advisor and Portfolio Manager at CIBC Wood Gundy to see why Canadian transportation and logistic companies are on his radar. Time now to see what's on the radar, and we are back with Andrew Pyle, Senior Investment Advisor at CIBC Wood Gundy, going to tell us why Canadian transportation and logistics companies on the radar. We'll start off with TFI Logistics Company. Mm-hmm. They're all struggling. The whole industry is struggling a little bit, isn't it?
This entire segment is down on the year. So we talked about value before in the last segment, Roger. And so what we're trying to do is look at a market like the TSX, which is, by the way, outperforming the U.S. And not that we think that valuations are stretched in the TSX in general, but we want to look for those sectors that offer some value going forward. One of those sectors right now is transportation logistics. And so TFI or the rails or even air transport, all of these stocks, if you look at the markets this year, are down, in some cases, huge. Mm-hmm. And we think that offers us some opportunities to get in and provide a bit of a buffer, right? Because when you have an overstretched market, Roger, you're looking for stocks that do provide that buffer if we were to enter, say, a general market correction. And we think that this sector does right now.
And what's driving that drop? Is it just people moving their money? Is everybody over in tech right now and mining?
Yeah, I mean, it's not the Baskin-Robbins flavor of the day or the year. Yeah. We're also in November going into December. This is tax loss season, so you look for the dogs in your portfolio to sell to offset capital gains. I'm not saying that that's the reason why these stocks are where they are this year, but at the end of the year, doesn't give them a lot of support. But if you're looking for those value plays, this type of environment really does open those opportunities up. These are really well-managed companies. And coming back to our Canada story, looking at cross-border or cross-provincial trade, which we think is going to improve going to 2026, we think that also gives a lot of these companies a leg up in terms of demand for transport. Again, whether it's rail, whether it's truck, or whether it's air.
Okay, we got a little bit of everything here. Let's talk about the individual stocks. TFI, which is a logistics company.
Yeah, so TFI, we think of logistics, we think of trucking. Again, very cyclical. So if we were in the middle of a recession right now, obviously this stock would be underperforming. I think a lot of that is in this sector, Roger. So if we look at what are our views on the economy going forward, we've had a lot of trepidation by investors that Canada and the U.S. could go into recession. That's definitely not good news for trucks. I would argue right now, though, that the market has priced in a lot of the bad news for recession into a company like TFI. If we start to get those rate cuts and start to alleviate that concern, this stock should be able to do well.
Yeah, because there has been concerns about a possible recession coming in. It feels like it's been.
Well, economists are great. We're really good at predicting, 5 of the last 1 recession, Roger, and markets are exactly the same, right?
Okay, let's move on. Cargojet is our next one, and it's been struggling. It's been dropping, hasn't it?
Yeah, same type of thing. I think the stock has been really hit coming into November. Again, a lot of this could have been related to tax loss selling. We've seen the stock actually bounce in the last few weeks, and I think this is a sign that you're starting to see that value investor look at a stock like Cargojet that has a really decent market share in Canada, for example, and looking at valuations down below $68 and saying, well, really is a good buy at this point. We've seen the stock rally up to around $79, but we think it can probably move higher.
And you see that bounce, do you wait? Do you think there's going to be a little fluctuation still, or is it hard to tell?
I think in these names, Roger, it's not, again, we don't want to time the market per se. I think you're looking at these names as providing long-term growth for the portfolio. You know, whether I should have bought it at 68 or should I bought it at $79. I think that you're really looking at the fundamentals for these companies. Yeah, the stock could pull back a bit. You could wait for a pullback. It may not happen. Yeah. But we like the thesis of what this sector offers right now, and we think the current valuations are good.
Okay, and the third one, well, it's actually third and fourth, CN and CP.
Yeah, I mean, CP's done a little bit better. CNR's had its issues, but I think you're starting to see the analyst community come back kind of more in favor with CNR. I think a lot of the problems that this company had in the last 18 months is starting to fade away. Both of these companies, I think, are well positioned to take advantage of what might happen here in Canada, cross-provincial. And both, again, compared to the general market, are trading at decent discounts to the growth sectors of the market like tech that we've been talking about.
And with CN, I believe they're talking about trying to go into Mexico as well. Was that?
Yeah, and I think this ties into
CN Kansas, right?
Yeah,
yeah, and they're looking to try and expand into Mexico.
And that's a growth area. I think right now, I mean, we haven't got a new trade agreement yet with the states. We don't know what even the acronym will be for Canada, the states, and Mexico going forward. But I do think Mexico actually becomes a growth area for the rails.
Okay, on that, we'll take a break there, and we're going to come back with Andrew, talking a little bit more about what is unfolding in the world right now. Coming up, though, headlines from the BNN newsroom. And, of course, our phone lines are going to be open for first call. You can reach us at 1-855-326-6266. Send us an email as well. First call, bellmedia.ca. CTV News is reporting Prime Minister Mark Carney will announce measures today to help Canadian steel producers and those in softwood lumber. Multiple reports suggest more financial aid will be announced for both industries. The move comes as steel, aluminum, and lumber sectors continue to deal with high tariff rates imposed by U.S. President Donald Trump. The Globe and Mail is reporting the Canadian Securities Exchange is considering buying CBOE Canada and CBOE Australia. The report says talks are preliminary, and there is no guarantee a deal will emerge. A CBOE spokesperson told the Globe the company was selling its Canadian business after only a few years because it is realigning its portfolio of businesses to sharpen its strategic focus. Shares of Urban Outfitters are up in the pre-market. The clothing retailer reported record sales and income in its latest quarter. The company says it saw strong results in early holiday events, adding customers were waiting longer for seasonal promotions to begin this year. The American retailer is planning for total company revenue to grow in the high single digits for the fourth quarter. And it looks like the rally is continuing south of the border. Taking a look at U.S. futures, all in the green. Dow up almost by 0.2. NASDAQ up by almost 0.5%, and the S&P 500 up by 0.3. Michelle Meyer, chief economist at MasterCard Economic Institute, says consumers remain engaged and ready to shop this holiday season. She tells Katie Greifeld and Romaine Bostic on the close that while spending can be volatile, she expects consumers to stay active in the economic cycle.
By the second half of October and into November, we saw a really nice acceleration in spending. So for the month of October, retail sales ex autos are up about 3.5% on a year-over-year basis. And we think that's a really good indication for where things will go as we look into the holidays. Back in September, we released our holiday sales forecast, which was for 3.6% year-over-year growth during that holiday season, with the e-commerce story really resonating, almost 8% year-over-year growth in e-commerce. So the data that we're seeing now with October coming in that mid 3% pace, this acceleration to early November, I think very much speaks to a consumer that is still engaged and ready to shop during this holiday season.
Which is interesting because, I mean, you just listen to some of the anecdotal data, if you'll call it that, about, people are feeling stretched right now. They're feeling frustrated. But it kind of reminds me of the pandemic when the narrative was very much, okay, the consumer is miserable, but they're still spending. And I wonder if you see any parallels between that period of time and what we're seeing now.
There are, in the sense that there was just a lot of uncertainty then, and there's a lot of uncertainty now. I think the consumer feels a bit unsettled because it's hard to predict what comes next when you have so many different headlines hitting that could influence your personal welfare, right? Your finances. So even think about the government shutdown. There's a lot of uncertainty. Will the government reopen? What does it mean for me personally? How do I think about the path forward for the economy? And that could be unsettling, which could have been contributing to some of the conference board surveys that we saw, the consumer sentiment surveys we saw for November. But I think a lot of it ultimately comes down to what can I afford as a consumer who's coming in and shopping? Do I feel like I have the ability to find the best value? Do I feel like I have the way to make my purchasing power work the most that I can? And do I feel like I have enough income today and future income in order to facilitate that spending? And the labor market, although it has certainly seen a lower rate of churn, it is still largely supportive. And there's still a lot of values out there. There's still a lot of promotions hitting, and consumers still have a lot of choice.
So is that a good thing, though, Michelle, with regards to the promotions? I mean, we were talking on the show last week about how most of us, our inboxes, email inboxes have already been flooded for the last couple of weeks with Black Friday deals, and I put that in quotation marks because apparently Black Friday was about 3 weeks ago, not 3 days from now. And it gets to this idea. I understand from a consumer's perspective that's good and entices us to spend, but how is that going to shake out when we start to see earnings in 3 months from time? Are we going to see margin compression? Are we going to see some pain for some of those retailers that maybe discounted too much?
Well, I mean, I'm sure retailers are trying to be as savvy as they can in order to make sure they're maintaining their market share. They're enticing the consumer, but they're doing it in a way that doesn't sacrifice their profitability. And, they're also navigating a different cost environment than they were last year. Last year, we had deflation, certainly disinflation for many categories. Costs were lower, and they were able to do even steeper and more meaningful discounts. This year, it's a little bit more targeted. Because we do have some of the tariff-induced price increases, some changes in terms of labor market conditions as well. So retailers are trying to navigate all of that while still maintaining that consumer interest.
So, Michelle, when we add all this up and we talk about kind of the state of the economy through the lens of obviously consumer spending, I guess my question for you really isn't so much whether things are stable now, but the idea is, do you think that this is going to carry over deeper into 2026, or is this sort of the last hurrah for consumer spending, or is this just kind of that reset and we'll get back to whatever the baseline normal used to be?
It's fascinating. I feel like there's been that story of a last hurrah for consumer spending throughout this whole cycle, because there's been this question of how long can the consumer continue to engage? How long can the consumer power this economic cycle? And I think there's just like a lot of swings in consumer spending, right? We've gone from periods where consumers have paused, they've waited, they've tried to assess what's going to come next in terms of the economy because of a heightened uncertainty or fear of the health of the labor market or their own, again, personal finances. And then they come back in when they feel a little bit more settled or they feel like it's the right moment to spend. So there's always some volatility in terms of consumer spending, just like there's volatility in the overall economic cycle. But to me, as long as the labor market continues to move along, as long as there's a low firing environment, wage growth continues, consumer balance sheets are largely healthy, and I think consumers will remain pretty engaged in this cycle.
Well, that's what I was wondering, Michelle, because, again, we're starting to get some economic data delayed, but at least it's coming out. And I wonder if what we're seeing when it comes to this still resilient, still spending consumer, whether that tells us something about the labor market, or is that not necessarily the direction that this information flows in?
No, that's a fascinating question, because we've been trying to figure that out ourselves. The fact that we see consumers spending into October and November at a healthy clip, does that indicate that indeed the labor market may have recovered a bit more? The September data showed a pickup in non-farm payrolls, so the numbers certainly improved in terms of job creation, although the unemployment rate was a little bit weaker with that pickup. So we'll see how things play out. We know from the jobless claims numbers that filing rates remain pretty low. We have other labor market indicators from ADB and from other private sources, but it's really hard to figure out the full picture, I think, until we get that BLS data.
And Michelle, just so we understand the relationship. So if we were to see a cooling down in the labor market, perhaps a contraction, I mean, how meaningful would it have to be to really impact consumer spending in a meaningful way? What do past episodes tell us?
Well, it's circular, right? When the cycle starts to shift, it kind of shifts together and feeds on itself. So the extent to which the labor market weakens, you start to see job reduction because of a stress on corporate America. That means that purchasing power of consumers won't be as strong and consumers will start to cut back, which then fuels back into companies resizing their workforce. So it's kind of a natural feedback loop in the economy. And that's certainly not happening at the moment. We're in much more stability. And seems like from what we're seeing from actual spending that stability continues.
Still ahead, we'll get more on a world-famous brewing institution leaving the U.S. for Canada. Also, our phone lines are open. Andrew Pyle is taking your questions. Call us at 1-855-326-6266, or you can email us. First call, bellmedia.ca. A renowned American brewery school is relocating to Montreal. The Siebel Institute points to changes in the U.S. for its move. CTV's Quebec Bureau Chief Geneviève Beauchemin has more.
This nondescript Montreal address, just a few blocks from the original site of Molson, the oldest brewery in North America, is soon to be home to a prestigious beer brewing school. Since 1872, the famed Siebel Institute has taught the fine art and science of brewing to generations in Chicago. But it has announced it will soon be last call in the U.S. Siebel issued a statement pointing to changes under the Trump administration. Recent regulatory changes in the U.S. have made it much more challenging for many of our international students who have become the majority of our student body to attend classes in person. To many in the brewery scene in the U.S., the loss of Siebel, woven into the history of Chicago, is heartbreaking.
But it truly is just a Chicago institution. And, if you talk to brewers of the modern era, not just in Chicago, but across the nation, it really is the place where people go and learn the trade.
So that's where we actually brew the beer here?
Quatre Origines has been brewing craft beer in Quebec since 2018. On tap from Montreal now, says the president, Michael Dornelas, is a university of beer.
Siebel Institute coming to Canada is big news. Essentially, they offer a wide range of education options specifically for this industry.
A prominent addition to Quebec's already vibrant scene as knowledge and workers will spill over.
I really think it's going to focus a lot of attention onto Montreal as a destination for beer, which the U.S. that's where all the focus is for craft beer. Like, we learned from them.
And the move is expected to come into effect as of this January. Geneviève Beauchemin, CTV News, Montreal.
And coming up after the break, some notable calls, and we'll get to Andrew's thoughts on those calls. That's just ahead. Okay, time to take a look at some of the notable analyst calls and recommendations. First up, JP Morgan raising the firm's price target on Best Buy to 99 from 97 and keeps an overweight rating on the shares. The company reported strong results with comp and margin upside. The analyst told investors in a research note. Now, the firm believes the third quarter report is Best Buy's first step forward with accelerating data trends taking the stock higher in early December. JP Morgan also raised the firm's price target on Urban Outfitters to 96 from 89 and keeps an overweight rating on the shares. The company reported a Q3 beat with broad-based portfolio momentum. The analyst telling investors in their research notes for that one. Meanwhile, Scotiabank analyst John Zamparo raised the target on Alimentation Couche-Tard to 88 from $84, maintaining sector outperform ratings. The new PT implies a 18% increase from the last price. Let's bring in Andrew Pyle, now Senior Investment Advisor and Portfolio Manager at CIBC Wood Gundy, to talk more about them. Which one would you like to talk about first, sir?
Well, let's deal with the two U.S. Retail companies first. We were talking about this off air in terms of, impact of things like, for example, the iPhone 17, which has had a pretty successful launch. I would argue a lot of that is showing up in the Best Buy numbers for that last quarter. Question then is, can you sustain that? Now, the rate increases that we've seen on Best Buy are not massive, Roger, not as big as, for example, Urban Outfitters. But I think tying into the last segment that we saw, it's doubtful whether the U.S. consumer is going to be as healthy as what we saw in the last quarter, given what we're seeing in the labor market. So I think this is a case where we look at these rating upgrades and some investors will say, well, now's the time to buy Best Buy, or now's the time to jump in on the Urban Outfitters rally. We would be a little bit more cautious on those two.
It was like Best Buy's raised its profit and sales expectations ahead of the shopping ramp up on Friday after that quarter. Is that, do you feel that's a little too optimistic?
I think it is. I think the health of the consumer is not as rosy as what we just saw. I think if you look at the layoffs that we're starting to see, for example, HP, McKinsey, these layoffs now are starting to become a little bit too regular, and will start to show up in the unemployment numbers. And I think that unemployment rate, at the end of the day, really feeds into consumer confidence. We had a consumer confidence read yesterday for the States that was not great. That ultimately has to square with what we think retail sales growth is going to look like, whether it's a Best Buy or Urban Outfitters. So, yeah, I think to your question, Roger, these views are perhaps a little bit too rosy right now based on the fundamentals.
And the Michigan report that just came out as well was it last week? I think they came out. The consumer optimism was.
Consumers are not feeling great. Now, it doesn't mean that consumers always do what they say, right? We know consumer credit numbers have been healthy, so that means that they're spending. But it also means that they're paying more for debt. And let's face it, rates are not down to zero.
Yeah.
We're talking about maybe getting rates down another point, perhaps in the next 4 quarters. The amount of debt right now by consumers is still quite high.
Okay, so you're taking a kind of wait-and-see approach with anything like that.
Yeah, on both of those, I think you just want to wait and see how the fundamentals proceed over the next 3 months before jumping in and saying, well, now's the time to buy Urban Outfitters.
Okay, and Couche-Tard doing well, even with that the coming up short on the attempt to get 7-Eleven?
Yeah, I think that's actually a positive. We've talked about this in the show before. I think a lot of analysts really didn't like the deal, and we saw that reflected in the stock price. And ever since we've seen that deal kind of disappear, analysts now can go back to the company's own fundamentals. And I think the read that we're seeing amongst analysts right now, Roger, is that Couche-Tard looks to be in a better place right now. The stock hasn't done a lot. We have seen some rating upgrades on the stock. We actually have Couche-Tard in our portfolio. We like the name right now. It's not going to go gangbusters, but I think it's a healthy foundation for the stock to continue to move higher.
And just to take the focus away from M&A and focus on getting things running smoothly.
Yeah, and as we talked about off air, the fact that we're now talking more about the food that they're going to sell in their stores, whether or not we're going to eat it or not.
The $3 and $4 and $5 deals.
Exactly.
I mean, I've tried them. They're food, and they're not bad. No, they're down in the States when they're those gas stations, and people need them.
Well, it's
there is
smart
that demand
too,
for it,
right? I mean, we're talking about what is going to be more successful in this environment: low-end product that people can afford, or high-end discretionary items that people may not be able to afford. So I think they're going down the right path right now. And I think that's why you're starting to see these analysts coming out and boosting their targets.
And they have talked a little bit about some expansion, but small, here in little pickups here and there.
And this is what they've done all along, right? They've built the market share that they have right now by doing exactly that and not going for a grandiose M&A target, which again, the community really wasn't happy with. So I think we can now focus on this company as offering longer term positive returns and not getting distracted by this these large deals.
Okay, we're going to leave it on that note there. When we come back, Andrew is a senior investment advisor at CIBC Wood Gundy. We'll take your questions on First Call. Time for First Call with Andrew Pyle, Senior Investment Advisor, CIBC Wood Gundy. And Mike, calling from Vancouver. What's your question?
Hello, my question is on Allied Properties REIT. It feels like tax loss selling. I'm just wondering what you think the future for Allied Property REITs going forward looks like.
All right. Thank you, Mike.
Yeah, good question, Mike. I mean, I'm not too sure whether this is just tax loss selling. I think this has been a pretty extensive slide in recent weeks. And I'm really hesitant, Mike, to start looking at stocks as offering fantastic value when we really haven't confirmed a bottom in that stock. I don't think we've done that with Allied. So I think I'd be waiting a little bit here to see if we can see some support, some stabilization in the stock before entering in. Allied obviously is in the office properties segment, which we've talked a lot about, Roger, in terms of, how healthy is it going forward?
Yeah.
I think it's probably healthier than what we thought it was going to be. We're starting
to see more and more people coming back.
Exactly, right? But there's still a decent amount of supply out there. So I think on this particular name, Mike, I'd be waiting just for some signs of stability before entering in.
Okay. Let's get into some emails. And the first one's from Peter. Great show. Thank you, Peter. We'll read your email now for that. All right. Could you give your thoughts on purchasing CAE now or waiting for the year end? Upsell or hold?
Great question. CAE kind of ties in a little bit with the transport thesis. I mean, the stock is basically flat on the year, trading around 36.53. I think, the long-term story for CAE is still positive, Roger. I think this is a company that's going to do well as we continue to see demand for air travel increase. We're going to see demand for new aircraft increase. That ties in well with CAE. And I think the fact that we've seen this stock kind of float around $36 as a floor in the last several months, I think we can probably see that as a base and move higher from there.
Yeah, and with AI and automation, that's the one thing we haven't heard a lot about is it doesn't seem like people want to talk about it yet, but planes automated and flying sans pilots, and I don't think people are ready for that one.
No, I think there are people that are not quite ready for getting into a car
without a driver
and having it drive you around. We are doing it.
That'd be me.
Yeah, I think planes we're a ways away from that. I mean, non-passenger transport, I think, is a possibility. I think if we're not putting people on a plane, if it's really just for transit or transporting cargo, I think that's placed. But no, I think, and that's why we are going to see this company, I think, continue to do well despite the AI talk that's out there.
All right, I'll leave it at that. I'm happy to have a pilot at the front there. Okay, next up is an email from Owen. Good morning. What are your thoughts on Microsoft? Is it a buy after the recent dip?
We like Microsoft, and whether this dip is over, I'm not sold on that entirely. I think the long-term fortunes for Microsoft. I mean, we've talked about this on the show before, Roger, with respect to AI, and whether you believe AI is overdone or overhyped or whatever. At the end of the day, monetization of AI is really what's going to get you across the finish line. If you look at companies like Microsoft, they're doing that, right? So this is proof that you can take AI, put it into products, sell them, and get people to buy them. So I like Microsoft longer term, Roger. I just think I'm not too sure whether we've seen the worst yet. But from a long-term perspective, yeah, no, we like Microsoft.
And what about the rest of the groups in the rest of the companies in there? Some thoughts on those?
Yeah, so we were talking about this off air. I'm really surprised that no one's asked about Google today. Because to me,
what about Google?
Google is the story, right? I mean, whether we're talking about Berkshire Hathaway taking a stake in Google, which is by all accounts a growth stock, almost 10 times in terms of price to book versus one, which would be a value stock. I think that was really surprising. But if you just take a look at the results that we've seen from Google in the last week, is truly remarkable. And it's almost like this diversification story within the Mag 7. We talk about rotation a lot. Usually we talk about rotating from Mag to other parts of the market. This is a great example of rotation within Mag 7 to another company that now has something that everyone wants, which is Gemini, and the chips that go behind that.
And NVIDIA is paying the price for it right now.
For now, it is, right? And but it's injecting doubts into the entire conversation, right? We've staked our claim on NVIDIA. This is where we're going to go. And now, lo and behold, that this week is a little out of favor. Google is not resting at all. We've seen the stock continue to move higher. Doesn't mean that that's not a bit of a bubble that's developing right now, but we have seen that mood shift.
And a little competition is probably good, though, too.
Competition is always good. Right? It's always great.
Get you scared, get you moving.
Innovate, on your right? Innovation. This is what you got to do.
All right, let's get back to emails. This one's from Francis. Good morning. As the subject is really in Mullen's wheelhouse, what are your guest analysts' appreciation of this one stock, and is the dividend safe? Thanks in advance.
So we'll answer the second question first, and that is, you don't want to talk about a dividend being safe as a guarantee.
Okay.
We think there's a good chance it is safe. I think the company's well run. This is a great example of a stock that is in the group that you and I talked about at the beginning of the show, which is transportation, logistics. And one of those few stocks this year that's actually up about 4%, whereas the rest of the pack has been suffering. So we think Mullen can continue to build on that. We think the stock is, the company's well run, and they're in a good position logistically wise, whether we're talking about trucking, even if we're talking about warehousing, which again is another strong segment of the company. I think the stock should do well.
All right, just a little patience with it, is by the sounds of it.
Yeah, but I mean, the analysts are good are happy with the stock. We've seen a decent pattern. It's not doing a lot. It's not an exciting stock, but it's holding value, and that's the important thing for investors looking forward.
And especially with everything else that's going on, I guess a little stability is not a bad thing to have as part of it, right?
No, we talk about it all the time. If you're concerned about valuations in the broader market, if you think we're going to get a correction, we've had obviously not a great November. The market's come back a bit, whether that holds or not. That's the time to start looking at the portfolio and looking at areas where you can maybe get some value, get some padding in the portfolio in case you get this correction running a little bit further ahead. So, and these are the companies that will get you there.
Okay, we're going to wrap it up there, Andrew. Thank you, as always, sir. Andrew Pyle is a Senior Portfolio Manager at Pyle Wealth Advisory at CIBC Wood Gundy. Thank you very much for joining us today, and thank you guys for joining us as well. And next up, Andy Bell with The Open. The market opens in 30 minutes.